Good morning, everyone. Thanks for tuning in today and joining us for this webinar. I'm joined today by Paul Edwards, Investment Committee member, Adrian Bentley, the CIO, and Josh Manning, founder and portfolio manager. So we just wanted to use this morning's webinar as a bit of an opportunity to sort of lift the hood on the investment committee that Manning have and how the experience of the IC is relevant from a day-to-day perspective in managing the portfolio. So Manning does have one of the most experienced investment committees in the Australian market, and between Andrew Chick, Paul Edwards, Adrian, they have a collective 100 plus years of experience in managing multi-billion-dollar credit portfolios. So I guess, to sort of start us out today, Adrian, you have had a career of 30 plus years in structured finance. So what are sort of some of the lessons and what have you seen in the past that's directly relevant to your role as CIO at Manning?
I think one of the main things is just the importance of having a very long-term perspective. So from what we're trying to do at Manning is protect investor capital. And we do that by sort of looking at each asset and going, how bad can it be? What is the sort of worst case scenario that we can foresee? And then try and structure around that so that there might be issues in particular loans that we invest in, but that doesn't translate to losses for investors because we built in various protections. And a great example, I think, of having a long-term view is if you just look at mortgage rates over the last 5 years, it looks as though we've had massive interest rate rises and they're really high. If you go back 10 years, they're pretty much the same where they were 10 years ago. If you go back to 1990 when they were 15.5%, it gives a different perspective to, and it's not to say 1990s are the same as now, there's a whole bunch of reasons why they're different, but it gives a different perspective on the extent to which tightening has been put into the economy. And I think it's that sort of stuff that gives you an idea of how bad can it be, why, and what protections do we need to put in place to insulate investors. And we do that through things like first loss protections, what's the skin in the game of our lenders because we're not a lender, and also which asset classes to avoid. And how do we, having identified the risks, look at, well, what can we do to either exclude that or box it in or whatever. And again, whilst there might be individual assets that might be having issues within the portfolio, the investor capital is well insulated from multiples of what we can see the worst case is. And that's really the philosophy.
So from, say, looking over the last 15 years sort of since the GFC, what similarities does sort of the post-GFC period have to now? And, is there...
Well, I think that whole period is really interesting because since the GFC, which is now 15 years ago, we've had this massive quantitative easing, reduction of interest rates, massive sort of stimulus, which has sort of transferred risk from the private sector to the government, who now has a whole bunch more debt. So it's sort of transferred that risk across. We saw that get rebooted in COVID, where, the sort of playbook was followed and finessed again. So we've got unusually low interest rates and unusually high liquidity. And when QE started in the GFC, everyone was sort of saying this is going to be really interesting when it unwinds, because when the economy really recovers, we're going to have high inflation and it's going to be difficult to manage that in an interest rate environment and so forth. So where are we at? We're coming out the end of it. We've got high inflation and it's difficult on a macro level to sort of manage it. So this was always coming. And it's just, I think, important to say, well, prior to the GFC, things were there was a different set of stimuluses and things were behaving quite differently. So we have to look forward and go, well, how might things be given the last 15 years has been a particular period in history?
As Josh said to me yesterday, history doesn't repeat itself, but it rhymes.
Absolutely. And, when we make investment decisions, we are pulling long-term data back. We're not looking at what some of the sort of vital signs of these asset classes are over the last 2, 3, 10 years. You've really got to go way, way back. And that's an important part of how we validate investments is to bring that rigor into the process. And from my perspective as part of the investment team that presents propositions to the investment committee members on a regular basis. I know that they're very seasoned and experienced people. I know they're going to ask me long questions about how this will perform over the long term in different economic environments, such as high inflation and so forth. So there's a lot that goes into every investment before it even gets to that stage. And I think that is really, really important, just to put that hard work in. And it really has paid off for us over that, almost 8 year track record of never having a negative month from credit losses.
Yeah, perfect. And Paul, now you're probably one of the few people still in the industry who has direct experience of the 1987 crash.
Yep.
So what sort of over your long career in credit, what are some of the key issues and timelines that you've seen, and what do you think that sort of brings from a true credit perspective to the Manning IC?
Yeah, when I think back, back to the 80s, for example, when I was a fair bit younger than I am now, and I started probably a credit roll 82, 83, 84, leading up into and that I can't remember, fair enough, 40 years ago, exactly when deregulation came in. But I was working in the industry when the banks were regulated, and literally credit decisions were controlled in effect by the government. And so when the banking system was deregulated, the banks were really challenged in trying to manage this new deregulated environment. And I think that's what really led into what I would call a speculative bubble in the corporate sector at the time. You might remember people like Alan, maybe you don't remember people like Alan Bond.
Not well.
But, there was Alan Bond and there was Christopher Skase and Elliot, I can't remember his first name, and a whole range of very colourful characters who were able to convince the banks to provide very high levels of leverage to their activities, which often involved speculative acquisitions, paying too much for companies, way more than they were worth, and so on and so forth. And then, of course, it all came to a head in 1987, where the share market, I think it dropped around 25% on a Black Monday, I think they might have called it.
Yep.
And I just remember sitting in the office, when that happened. It was like, wow, the market's just dropped 25%. And, borrowers were, concerned. We still were concerned about the exposures.
And so commercial property was a big issue at that point in time, wasn't it?
More in 93. More in 93, commercial property was the issue. In 87, it was more speculative corporate style lending.
Yep.
And concentrated amongst a handful, say, of entrepreneurs. So these were very large loans, and that was part of the thing that we bring to Manning. I bring to Manning is avoiding very high leverage and very large loan sizes.
Oh.
Because if there's anything I've learned in 40 years, it's concentration risk, large exposures that damage your performance.
Yeah.
And I think these are good point. They feed directly into the philosophy, because at that time, the guardrails were removed that the government put in place. So everyone was sort of like working out new products, new ways to do things, working out where the guardrails are. And I think the perspective that we're trying to bring is you need guardrails in terms of portfolio construction. You learn from the past in saying, what do those guardrails look like? How do you impose them so that those things that we learn from don't happen again, or you're minimising the chance that they do? So I think that whole point about having guardrails is a really, really important point to understand. Yeah.
And Paul, we were having a conversation a couple of weeks ago, I think it was, that you were sort of explaining to me from your perspective what some of the issues in the GFC were from a credit perspective.
Sure. Yeah. So that was fundamentally a banking crisis, global financial crisis, but to me, I always saw it as a banking crisis. It really was started by a lot of what's now called subprime lending, I suppose, lending to borrowers where there was no evidence that they could repay the loans. Again, very highly geared structures underlined these exposures. There was no recourse to the borrower and things like that. So in effect, then arrears rose, losses rose, and then the confidence was lost in the banking sector, and then we had this banking crisis.
Obviously it started in the US, then contagion around the rest of the world. So
Yeah.
I guess from a transparency perspective, which the GFC didn't have, how is that relevant for the investment committee and Josh, for you, when you're going out talking to the lenders that we fund, and what does transparency
I've got
mean?
an interesting story on that. I remember I took a proposition to the investment committee, and the investment committee asked me a number of questions, and I took that to the counterparty and asked them, and they refused to answer a few of them. And that's almost the deal done. Like, if they're not willing to tell us everything, they're not willing to be transparent, then we're not going to put our capital with them. So I didn't even bother going back to the IC. I know that there's just no appetite for any sort of obfuscating key information from us. Like, that's essentially what we're targeting here, is getting right down to the very granular. And I think that was one learning from me from GFC, was there was a detachment from the deal doers and the granular what's happening on the ground. And we put a lot of emphasis on that. We don't rely on third-party research. We do it all in-house. And I think that's such a vital thing, is really understanding that granular. And that's what the IC, requires, which I think is very prudent.
Yeah.
Absolutely.
Yeah, and we often talk to clients about, I think it's one of the points on the screen at the moment, is this product is, the Manning Monthly Income Fund, which is the flagship fund of the business. So we run 3 strategies. That fund is designed to be a through the cycle product for investors, so direct investors and advisors. The portfolio targets complete diversification. So what are sort of some of the guardrails that you look for, not from an asset structuring perspective, but when you're building a portfolio, saying, we want to avoid this area, or we want to avoid this asset? Sort of, can you elaborate on some of those sort of asset metrics, I guess?
Yep. So I can have the first cut at that. So firstly, the fund has an investment policy statement that's a very granular, sets out what the fund's trying to do, how it goes about doing that, but also a very explicit policy around concentration risk. And that has things like counterparty concentration limits, exposure to certain sectors, how much we're willing to participate in those. It has policies around large loans. Almost all these stories we're talking about now, it almost feels like it's the opposite in the investment policy statement, which is deliberately going about preventing these issues that have reared their head over the last 40 plus years since we participated in the industry. And that is a very useful tool that sets out the strategy of the fund. The implementation, how we structure deals, that's a different discipline, but at least from a very deliberate perspective, there's a lot of guardrails in place that have collaboratively been put in place to protect capital.
And it's not about forecasting when things might get difficult, because the whole idea of credit is through the cycle, is you're not trying to trade in and out. So you start from the position of, well, what happens if it does go bad? We do reposition the portfolio from time to time, because on a quarterly basis we have a macroeconomic sort of review where we look at leading indicators, coincident indicators and lagging indicators, where we're basically saying, where do we see areas of concern? Where should we maybe get less involved in new loans? Where should we be tightening up our particular requirements in certain areas? What does that mean for pricing of various assets?
Yep.
So within the guardrails that Josh is speaking about, there's very deliberate policy of how is the book actually going within those rails? Is that looking the way we want it to look?
Yep, that makes sense. And more stories with Paul. I remember we had another conversation a couple of weeks ago, and probably some of the clients who are tuned in now would recall having several conversations about construction finance. So, Paul, we were talking about your experience from sort of credit as a whole and why construction finance is an asset that Manning monthly income funds does not participate in. So
sure, I would say in all of my experience that's the most risky area to invest in is construction finance. You mentioned the 90s earlier, and there was a big speculative bubble that developed then in construction, and it almost sent Westpac Bank broke. And there were two issues there. One was the concentration risk, which we've already spoken about. So they had a very large exposure to construction. And then when the construction bust happened, well, then it had a big impact on the bank. So in our case, in Manning.
So what was the bust due to at that time?
Well, there was a recession in the early 90s.
Rates went up.
Rates went up, and unemployment rates went up. So demand for property was falling.
So the sort of the settlements on the completed projects weren't aligning with forecasts and so on and so forth. Yeah.
And there was a lot of specialised construction. The building of, say, a gymnasium, for example. It's like people couldn't afford to go to the gym anymore. So
right.
Or a marina. Well, people couldn't afford fancy boats anymore because the economy was under a bit of stress.
Yeah.
So specialised construction is probably the absolute worst thing. 3 or 4 townhouse development or something, it's going to be okay.
Yeah.
But
to a degree.
Yeah. It is. So essentially, we just avoid it. We just avoid it. And I was thinking when you were talking earlier about how we've structured the portfolio, and it's probably one of the most diversified portfolios that you could imagine. It's like more diversified than, in a sense, needs to be. I mean, our average loan size would be what?
Depends.
Less than $1 million. Average loan size. Across the whole.
Oh, easily. I mean, mortgages, it's around that, and then the other asset classes are far smaller. And largest concentration in the book is less than 1%. So we're very deliberate in how we go about structuring that. And I think you've mentioned speculation. Speculation is what I think about a lot when we're assessing deals, and that construction, speculation of the development, and then a speculation what they'll get for it in the end. So it's sort of the compounded element that is particularly sort of outside the risk appetite of the monthly income fund.
Absolutely.
Yeah. And I guess I often get, I'm just sort of weaving in questions that I know people who are sort of watching now, we've discussed before, but it's always good to hear directly from the IC. Sort of from straying from the topic a little bit, but from an asset structuring perspective, I think people would be keen to hear just from a high level, sort of what are some of the checks and balances or the alignment that you ask for from lenders? And then, second part, how are arrears relevant? Because obviously, there's parameters allowing for a certain amount of arrears, which is normal. So if you guys could just sort of, give the viewers a bit of an explanation around those.
I can lead off that a little bit. I mean, in terms of sort of trying to, get this point before about really understanding what's going on. So some of the things that we look at, we're not a lender, so that enables us to diversify. But we look at the alignment in terms of how does the lender make their money? Are they trying to sell another product while at the same time, they're trying to sell a car at the same time as originating a loan, or do they just want a loan? Because then they're very much focused on that kind of product. How much personal equity or business equity is in that business to support them? How much of that equity is put aside to support, an initial level of losses in the book, so that the book can have some losses, but they're wearing it before anyone else does. That means they have a high level of belief in what they're doing.
Yes, if their capital's at risk.
Their capital's at risk before anyone else, they're going to take it a little bit more seriously. Where's the income from their business being derived? Is it being derived from the excess of the book after all the lenders have been paid, or are they getting fees from out the side, which means they don't really need to worry that much about how the book's going? So it's this real alignment of, for us to get involved, the lender has to really care.
Yep.
And on top of that, we know a lot of people around the market over the years, and most people we deal with, we have come across, and reputation, track record, the style of person that they are, what they know, that's really crucial. So Josh talks about really drilling down and getting to know the people and meet the people, that sort of question about if they're not going to be forthcoming.
Yeah, unpicking the behind the scenes of their business.
It really, you've got to see the whites of their eyes, because you want to see the reporting, and they want to be true to what they're saying. So quite often our due diligence process, it's not just a 5-minute job. It might be 2 years. You watch them for a while. Is what they say they're going to do what they do? Because then you can sort of build some reliable we can trust these guys. That is a reliable set of data.
Yeah.
So it's really that getting into the hood and drawing on the collective knowledge that we have, that quite often doesn't come out until an issue's been put in front of us. And you go, I remember, and it comes
how to
out.
deal with this.
You go, I had a similar instance to that once, and this is what it meant, and maybe maybe this will happen before. How do we deal with that?
Yes, I agree with all that. I think the arrears point I'll pick up on, because I do think it's often quoted as a very simple measure to try and compare quite complex issues. And to give you an example of that, so let's say there's 2 loans or 2 books of loans. One is loans to medical professionals. Those loans are used to, quite often, if a doctor goes into a new practice, they can borrow money to buy goodwill in the doctor's practice. And then there's no security over that. They're literally just buying in, giving it, and then they've got a slice of it, but they can't sell it or do anything with it. The other is a low LVR, first ranking residential property mortgage. So what our view is, you could look at 2 propositions and say, well, the medical loans have a 1% arrears, the mortgages have a 2% arrears, therefore medical loans are half as risky as mortgages. Well, in fact, 2% in mortgages, say if it's under 30 days arrears, is probably acceptable. 1% arrears for zero security large loans to medical professionals is alarming, because there isn't protections in place to measure that. So people sort of saying, well, you've got 1%, we've got 2%, we're more risky. It doesn't work that way. We wish it was that simple, but it's just simply not that simple. So you've got to go deeper. You've got to look at the granular. You've got to look at security. You've got to look at track record. You've got to look at all the other contractual rights that an investor has, and then you can form a view on it. And it's not easy. It's quite specialised. But I think it's something that people point to, but unfortunately it's not.
I think it's a relatable, arrears. And you think, does arrears must mean losses?
Exactly. It's just not. It's not that simple, and there's better ways of looking at it. But arrears are useful, part of the conversation, but not the holy grail.
And they're part of the structuring. So, for example, you look at mortgage arrears, which they're rising at the moment, but they're from an incredibly low base. From a longer term perspective, they're still very, very low. And with our sort of view of how bad can it get, going back to how bad has it been, then we're structuring around protections that are multiples of how bad they have been. So in that context, you go, are we really worried about current rates of mortgage arrears and so forth? Well, it's always interesting to look at. It's always important, but in context and in terms of protections that we've got, it's sort of expected. It's nothing alarming, and I think
it's relevant to the LVR of the asset that the arrears are on.
And the base case for when we enter is that the arrears rates are way higher than what they are now. So it's almost like we haven't even met base case for a lot of these investments that they're assessed on. So it's quite modest, I think.
And we basically try and build in protections that if something unforeseeable happens in the economy that happens to cause a downturn, and we would expect that to impact arrears, that we have a very high tolerance for the protections in the portfolio for those arrears to happen, and we're managing still not to take any losses.
And we've, just before the start of this webinar, Josh and I were having a conversation about exactly this topic. We've been doing this in this specific fund for approaching 8 years now, and historical arrears levels, also as Adrian mentioned before, have bounced around all over the place. And it's
never had a dollar of loss in this in that space. So it's sort of arrears are normal. It's part of it. That's how we think about it. We build it in, and there's lots of protections. So it's a bigger picture you got to look at, I guess.
Yeah. No, I think that's good because we get the question all the time, so it just adds a little bit of colour from a real asset selection IC perspective. So, we might flip to. We've got a couple of questions that have come through, so we'll flip to the Q&A for a few minutes. And if anyone does send through questions, we don't have time to answer them all, which I think will be the case, we will get back to you directly. So thank you for your submissions. The first one is, as interest rates have climbed, do you find that your fund is sacrificing credit quality or security?
No.
I was going to say that.
Look, we've got a floating rate benchmark, which means as interest rates rise, then the borrowing rate of our client base is sort of going up. So what we sort of look at is, there's a separate question of what are credit spreads doing? What is the spread above that base rate doing? And if people get cautious and concerned that that sort of base rate goes up, if everyone gets, really excited and thinks the world's wonderful, those sorts of things come down. So conversely, it's when the world is running marvelously and everyone thinks nothing could go wrong, it's harder to get the protections you need and the yield you like because everyone's piling in. Whereas at the moment, if you're really selective about what's going on, you can find really good asset types. Some people are sort of concerned with and the spread's there for a little bit higher. The ability to go to a lender and actually speak with them and say, look, we can be there as a reliable longer term sort of party. These are the protections we need in place. It's probably easier for us to get those things in the current sort of environment.
So actually when money was cheap, sort of going back to say 2021, and there was cash in cycling in the economy, chasing a lot of these assets, you were finding that it was almost less advantageous than
and you'd have to let deals go because we couldn't get the protections that we wanted, or we didn't get a yield that we thought was appropriate, and so you'd have to go, well, we can't compete on that, we'll stop with it.
Yep. I think the industry talks a lot about what's your return target, and I think that's useful, but the way that we think about it is, what is our risk target? What's our risk appetite? We're targeting a risk appetite through the economic cycle, and if yields in the market for that risk don't meet our objective, then we're not going to take more risk. That's like the cardinal sin of credit. We would sacrifice returns to maintain that. And I think that's one of the key ways that you protect capital, is to make sure that you keep that risk profile through the cycle and just keep delivering on that. So it's a sort of a core belief that we have.
Yeah.
I think it'd also be fair to say, although the interest rates have risen quite markedly over the last year or so, the arrears levels are actually surprisingly low. Like, it doesn't seem to have had a big impact on arrears. And I think the reason for that is because the economy has still very strong at the
low
moment.
unemployment.
And one of the biggest contributors, you just took the words right out of my mouth, is when unemployment rates go up.
Yeah.
That's when credit risks are elevated.
Yeah.
But where we've got the full employment, as we've got at the moment, it's a testament to what's happening in the books and the banks and our own book, that problems just haven't arisen.
Yep.
Um,
That's not to say that they won't,
Well,
but
we've been
that's what
expecting them for many years, and
Yeah.
they will come,
They will come.
and we're ready for them. And I think that's the sort of the secret sauce, isn't it? To not just think that the current state's going to prevail, but being ready for these issues and having the right structures, having the right counterparties. And a big part of my job is monitoring. You know, we have all these contractual rights in these transactions, so we're always ingesting a huge amount of data, looking for signs of stress, and when there are, we're on the front foot, and that means sometimes we are exercising rights to, you know, get our capital back, and that's not always sort of a really attractive thing to do, because it's just easier to leave it there and pretend there aren't issues, but that's not what we do. You know, if there are risks, we pull back wherever we can, because there's plenty of great places to deploy
And there's
capital.
one of the things that you have nowadays is obviously a lot more data. So there's positive rating, credit ratings on individuals, whereas, you go back not too long ago, it was only negative sort of information. So there's a lot more data on borrowers, but there's also a lot more data in the portfolio. So my turn to tell a story. Back in the early 90s, I was doing one of the very first mortgage-backed deals, and it was for a bank that had never actually done it. And the main data, they collected a whole bunch of data, but never put it in the system. So the main data that they had on their loan book was they got X dollars worth of mortgages at the beginning of the year, and they wanted X dollars plus 5% at the end. And so they didn't have any data as to what's the average life of a loan, what's the refinancing of a loan, how much do people pay down. No idea, because it didn't matter. They just had to go out and originate more. The disciplines that you have in this sort of asset-backed sector is you're putting lots of boxes, guardrails, requirements, data requirements in there. And so the amount of information that you've got to understand which cohort's suffering, what's the composition of the portfolio, how is it behaving, how is it performing in different points of time. There's a massive amount of information that's sort of built up. And we draw from that type of stuff to go, let's not get lost in the weeds, but what are the big things in there that we need to look at? And what are the meaningful things? So I think, with fintech and much more data-related type stuff, obviously you need to put the real person experience stuff over the numbers, because, numbers can lie, and just they're good, as good as the input and the models that you put them into. But there is that data to use when making judgment calls, and I think it's quite different from previous history.
Sounds like it was harder in the old days.
I was a bit more seat of the pants. But, that's how things start. And you put more protections in, you go, well, I don't quite know what's going to happen, so I'll put a big buffer in. And if
I guess that's, Josh, having the right people at the table to help you on a day-to-day basis.
And having the rigour that it's not just me making investment decisions, doing deals. There's a lot of rigour around what we require, what the due diligence looks like, what the investment committee needs. And when they're not 100% comfortable and we don't have a unanimous vote, then it's back to the issuer, working through the issuers, the issues, and making sure we're comfortable getting the answers that are satisfactory. And if we don't, then we just move on to the next deal that is attractive. So there's a lot that goes into each one before it even gets a look at going into the portfolio.
And we are chatting away, but I would like to get one more question in. We've got, as I mentioned, we do have some lined up, so we'll email everyone directly who has asked a question that we're not getting to. But an interesting one I do get relatively regularly is what would happen to managed capital if a lender goes bankrupt?
Okay, I can take that one. Well, unfortunately, these things can happen, do happen, have happened. So the starting point, the where we come in is we assume that will happen. We assume their arrears will go way higher. We assume there's going to be all these problems. So when you go into a transaction assuming that these are the issues that are going to happen, then you're putting the right sort of buffers in place. You're putting a bankrupt remote structure in so that our capital is segregated from the capital of the issuer. So if the issuer goes bankrupt, they can't touch our capital. You're looking at sort of alternate servicing arrangements. You're looking at all these types of measures so that when that does happen, the structure not only survives, but we get our capital and our interest back. And that has happened over our time. We have had lenders that have gone, unfortunately, just run out of equity capital, or something's happened and they've decided to do something different. And in all those circumstances, those structures with trustees, security trustees in place, survive. They continue to get our capital. We get repaid, and in every circumstance, it's been, when they've been in wind down, we've got our 100% of our interest and principal repaid. So, like, starting off with assuming the worst, hoping for the best, but assuming the worst, I think puts us in good stead to, be able to have those structures survive.
And an example of that, Josh sort of mentioned, you've got this box of assets that's performing well, independent of what might be going on with the actual lender in the first place. One of the exits that you can have on that is if somebody does get into trouble, then they're going to want to try and wind the business up. So what's sitting there is a bankruptcy remote box of assets that's performing really well, that has value. And some of the examples is that'll be sold to somebody. Somebody will gladly
Not
buy
relevant
that.
to the originator.
Somebody will come along and buy that, and then we'll get paid out. And so you go, that's not a problem anymore because we've got our money back.
So there's a couple of ways.
Yeah, and it's also a
out.
self-liquidating asset class. Like, these loans are designed to pay themselves off regularly through time. So we're quite well placed just to.
It's not a 30-year mortgage.
Exactly. Yeah.
Perfect. Well, I think we've run out of time today. So thank you everyone who's joined us online, and we are aiming to do these webinars on various topics sort of every quarter. So I'm sure we'll see you all before the end of the year.
Thank you.